Scene script. Have you ever wondered what separates successful real estate investors from the rest? Could it be a secret weapon? Today we uncover the 1% rule, a simple yet powerful tool used by savvy investors. Welcome to the fascinating world of real estate investing, a realm filled with opportunities, challenges, and a fair share of secrets. Today we're going to reveal one of those secrets, a concept that has the potential to transform your investment strategy and set you on the path to success. We're talking about the 1% rule, a principle that is as simple as it sounds, yet holds immense significance in the world of real estate investing. Now you might be wondering, what exactly is this 1% rule? Well, in the simplest terms, it's a guideline that investors use to determine if a potential real estate investment is likely to be profitable. The 1% rule is highly regarded in the industry and is considered a key to successful real estate investing. But why is it so significant? The 1% rule serves as a litmus test for potential investments. It helps investors sift through numerous options and pinpoint properties that are likely to provide a high return on investment. Essentially, it's a compass guiding investors through the vast ocean of real estate opportunities. The beauty of the 1% rule lies in its simplicity and effectiveness. It's a straightforward calculation that requires minimal data, yet it can yield profound insights about a property's potential profitability. And the best part? Anyone can apply it, regardless of their level of experience in real estate investing. Now, imagine being able to quickly and confidently assess potential investments. Imagine having a tool that helps you navigate the complexities of real estate investing, enabling you to make informed decisions that lead to successful outcomes. That's the power of the 1% rule. We hope we've piqued your curiosity. As we delve deeper into the world of real estate investing and the 1% rule, we're confident you'll find this principle to be an invaluable addition to your investing toolkit. Now that we've piqued your interest, let's delve deeper into what the 1% rule is and how it works. So what exactly is this 1% rule? It's not a magic spell, but it can certainly work some magic on your real estate investments. Let's dive into the heart of the matter, the 1% rule. It's a simple yet powerful tool that can be your guiding light in the vast universe of real estate investing. The 1% rule is essentially a guideline that suggests a rental property should rent for at least 1% of the purchase price to generate positive cash flow. Now, let's decipher this further. Imagine you're looking at a property priced at $100,000. According to the 1% rule, you'd need to rent it out for at least $1,000 per month to make a positive return. Simple, isn't it? But why is this rule so significant? Well, it aids in quick assessments. By applying this rule, you can swiftly rule out properties that are unlikely to provide a good return on investment. It's like a first-line filter to help you navigate through the myriad of potential investments. However, remember that while the 1% rule is a valuable tool, it's not the be-all and end-all. It's a starting point, a quick litmus test, but it doesn't replace thorough due diligence. You'll still need to consider other factors like location, property condition, market dynamics, and more. Let's take a practical example to illustrate this. Suppose you come across a property with a price tag of $200,000 and the potential rental income is $2,000 per month. That ticks the 1% box, right? But if the property is in a location with high vacancy rates or it requires significant repairs, the 1% rule alone won't guarantee a successful investment. So, the 1% rule is a fantastic starting point, a compass to guide you in the right direction. But like any good explorer, you'll need more tools in your kit to navigate the exciting, complex, and potentially rewarding world of real estate investing. With the 1% rule in your investor toolkit, you're one step closer to making more informed investment decisions. But how can you apply it effectively? Scene script. Knowing the theory is one thing, but seeing it in action is another. Let's take a look at how the 1% rule works in the real world. Imagine you're eyeing a beautiful piece of property in your town. The asking price is $250,000. To apply the 1% rule, you'd need to determine if this property could potentially generate at least 1% of the purchase price in monthly rental income. In this case, That would be $2,500. If the average rent in the area is less than that, it might not be a good investment according to the 1% rule. Now let's consider another scenario. Suppose you're looking at a property listed for $100,000 in a neighborhood where the average rent is around $1,000. This property meets the 1% rule because the potential rental income is 1% of the purchase price. It might be worth considering further, but remember, the 1% rule doesn't tell the whole story. It's a quick and easy way to screen potential investments, but it doesn't take into account other expenses like taxes, insurance, and maintenance. It's also important to consider the property's location, condition, and potential for appreciation. Let's take a final example. You find a property for $300,000 in a prime location. The average rent in the area is around $2,500. While it doesn't meet the 1% rule, the property's location and potential for appreciation might make it a good investment anyway. You see, the 1% rule is not a hard and fast rule, but a guideline. It's a tool in your toolbox to help you quickly analyze potential real estate investments. It can help you avoid properties that are unlikely to generate enough rental income to cover your costs. But it's not the only factor to consider. As you can see, the 1% rule can be a powerful tool when evaluating potential real estate investments. But what are the benefits of using it? Why should you care about the 1% rule? Well, it offers several compelling benefits that can give you an edge in real estate investing. Now you may be wondering, what makes this rule so beneficial? Let's delve into it. The 1% rule can help you avoid one of the biggest pitfalls in real estate investing: overpaying for properties. It acts as a financial compass, guiding you toward decisions that make sense for your wallet. If a property doesn't meet the 1% rule, it might not be the best investment. This rule can help you steer clear of enticing properties that might actually drain your resources in the long run. Another significant benefit of the 1% rule is its ability to estimate potential rental income. As an investor, you want to know if a property can generate a steady cash flow. With the 1% rule, you can quickly calculate the minimum monthly rent you should be earning from a property. By doing so, it gives you a glimpse into the future, providing a snapshot of your potential return on investment. But the benefits of the 1% rule don't stop there. It also empowers you to make more informed investment decisions. Real estate investing can be a complex landscape to navigate, with countless factors to consider. The 1% rule simplifies this process by giving you a clear, easy-to-follow guideline. It cuts through the noise, helping you focus on what truly matters, the financial viability of your investment. Furthermore, the 1% rule can be a useful tool when comparing different investment properties. By applying this rule, you can easily assess which property is likely to offer a better return. It's like having a secret weapon in your real estate investing arsenal. The 1% rule isn't just a theoretical concept, it's a practical tool that's been proven to work in the real world. Many successful investors have harnessed the power of this rule to build profitable real estate portfolios. The 1% rule can be a game changer in your real estate investing journey, but don't just take our word for it. Let's hear from some real estate investors who've used the 1% rule to their advantage. Our first story comes from Jane, a savvy investor from Chicago. She purchased a property for $200,000, following the 1% rule. She ensured her rent was at least 1% of the purchase price, which in this case was $2,000 per month. Jane's property not only covered its own expenses, but provided a tidy profit each month. Jane's smart investment move, guided by the 1% rule, allowed her to generate passive income and build wealth. Next, we have Mark, a real estate investor from Miami. He bought a property for $300,000, and he too applied the 1% rule. Mark's rental income was $3,000 per month. With time, Mark's property appreciated in value, and he was able to sell it for a substantial profit. But even before selling, Mark was making a profitable income from the property each month, all thanks to the 1% rule. Lastly, meet Sarah, an investor from New York. She had a slightly different approach. She identified a property selling for less than its market value. She purchased the property for $150,000, but its market value was $200,000. Sarah's rent was 1% of the market value, not the purchase price. This meant she was earning $2,000 per month in rent. Sarah's clever use of the 1% rule helped her maximize her return on investment. These are just a few examples of how the 1% rule can guide your real estate investment decisions. It's not just about the numbers, but also about understanding the market and making informed decisions. The 1% rule is a simple yet effective tool that can help you identify profitable investment opportunities. As these success stories demonstrate, the 1% rule can be a powerful tool in your real estate investing arsenal. Will you make it part of your strategy?